Hello and welcome to another episode of the Swing Trader Status Update. This is our weekly show that we do Tuesdays at 5 p.m. Eastern every week. And so we're glad that you could join us because there's certainly a lot to talk about the current market. And to help me do so on this March 11th, 2025 is Mike Webster, our senior market strategist. How you doing, Mike?
Good. How are you?
Are you getting a little bit of rest and relaxation in with the market correction?
Dude, I wish, man, we're both so busy with so many things that
It's like catch up time, right? It's
yeah,
like all those projects that have been, kind of on the back burner. Yeah, there's a lot of things that we have on the firing pans, or is that right? No, I don't know what I'm
yeah,
talking about. I'm
I
I'm
don't know
mixing
either, man.
metaphors.
It's
But let's
okay.
get right into it and talk a little bit about the market because, um, I think we were both a little surprised with how quickly things got ugly. I mean, we certainly were expecting after this December 18th, bad break that was going to take some time to heal. But then, we kept on kind of going back and forth, and the trading range seemed like the way we were going until we just really, accelerated on the downside. I mean, certainly the February 21st was when things started really getting hit. The indexes took a little bit longer, but then, man, when we crossed 19,000, it was right to the 200 day. You looked like you were maybe gonna have a bounce there, and once we passed that, it was look out below.
Yeah, frankly, the day after we try to bounce at the 200 day is the worst day on that chart, to me, because it really broke. It was an expectation breaker, which something you and I and Charles Harris came up with that term and terminology, and it really can be a game changer when you have something that's set up in a certain way, either positive. You can have positive and negative expectation breakers where it does something really out of character, and that was out of character. I mean, I know we were into this downdraft, but when you get support at the 200 day, the way we did with a big spread closing dead at your highs, just coming down, just touching that 200 day, we should have bounced at least up to the green line, the 21 day, if not the 50 day, and then rolled, even if we were going to come back to where we are right now. But the fact that they did that on the very next day, and I know we've been in such a news driven market
Mhm.
where that is dictating a lot of these swings, but even so, that was telling you that there's a big shift going on, and I think it feels like a lot of money is leaving the US, and we don't know if that's just temporary or it's going to be something that happens the rest of the
And when
year.
you say leaving the US, you mean US stocks, not like
US
it's,
stocks.
fleeing, into
Yeah, no, not no, I should have been clear. Leaving our market and
Yeah,
going into like foreign markets, whether it's China or Europe or Japan or what have you, or even into like gold and things like that. Like it just feels like money is moving away from the US, across the board, whether it's tech stocks or even slow and pokey stocks. So that I know we're in this don't like to use the word oversold because Bill hated that term and I hate it too. But when you're in this position where you are going straight down, it lends itself to a mean reversion type of trade. So it'd
right.
be very normal and natural. And that's what you're always asking yourself is what would be normal and natural here? It would be a bounce up to the 200 day, a test up to the 200 day from here, because today we were barely down. And today's actually good action in
Mhm.
that. If Bill, the founder of IBD, were with us, and because he uses volume, not something I use, he would call this a heavy volume without further price progress on the downside, meaning we,
HVWFPD, for those that looked at his model books.
that was a tricky one the first time we both saw that, right? It's like, Bill, what are you doing? Um, and so, but yeah, heavy volume without further price progress on the downside is another way of saying it is supporting action, where you've
Mhm.
come in, you broke badly yesterday, but then you had more volume today, and couldn't really go lower. Now we had some news midday, from Ukraine related, and I'm not totally up on the news because we're both so busy, but it appeared that that's what was lifting the market with some ceasefire um,
Yeah, so
talks as well.
I'm not sure. I don't know how it ended up, but I know that Russia still had to accept it, but
Okay,
Ukraine was saying. But then there were also, it looked like, early in the day, Ontario was, putting some electric, uh, you know, um,
tariff.
fees and tariffs and everything, and those got walked back as the commerce secretary opened up talks with Ford from Ontario. So yeah, there was a lot of, and you can kind of see that reflected in the day, a lot of back and forth action, a little bit of tossing to and fro based on news events.
Yeah, and I mean, from a swing trading standpoint, I mean, we were in cash yesterday, we were in cash today. I mean, we were very light in on Friday and went to cash near the end of the day, just because this is a market environment that is very, very dangerous. And even though to me it looks like what would be normal and natural is a bounce up to the 200-day, and then you see like we need a lot of time when you let's go to the weekly for a second because it's important to kind of get that picture in your mind like when you've looked at enough charts the way both of us have and most people who are listening, it's not normal to come down this sharply and then just bounce straight up to new highs. I mean, the one
Mhm.
time we did that was COVID, and that was very unique and specific. We don't have to go there now, but it was straight down, straight back up, and it was really unprecedented before and after. So most of the time, it takes a while to work itself out. Yeah, you can do you can change the scale if you want to show the COVID stuff because not everyone
Yeah, you know what?
totally
I'll
knows.
just go. I'll just go back there
Yeah,
since I
why
already.
not? Do it the
So
old-fashioned
yeah,
way,
there you
yeah.
go.
So that is a one-off, and if the, government were gonna just throw everything at this problem, at the market problem or the economy problem, then we get a snapback like that, but that's not really doesn't appear to be in the cards at all, but it doesn't mean that we can't have a move back up the right side, but let's go back to our normal market.
Hmm.
Wait, actually, while you have that there, yeah, let's go back to that. The 2018 that I think we're going to talk about, but since
Yeah.
we're on a weekly, that's a little bit more normal of a very aggressive sell off, and when we look at the daily later, we can see that it really happened in three waves, and then you inch up the right. I mean, even though it was said it had some powerful days, you didn't just snap right back into new high ground like you did after COVID. That's more
Yeah.
normal and natural, meaning you need time
Not as not as
to
V,
reshape. Yeah.
and, just since we're on the topic, if we, wanna kind of talk about, 2022, what happened there, it was a little bit more gradual, on the downside, real punishing, but, the way that came up on the upside, it was not back to highs in a month's time.
That's what we don't wanna be in, but we could be in that. And what I would suggest people do is focus their eyes on that black line. That's your 40-week, essentially the same thing as the 200-day. When you're above that, on the most basic level with charts, when you're above the 200-day, you're in a bullish phase. When you're below the 200-day, you're in a bearish phase. At least that's the way I like to look at it. And so when you're in a bearish phase, you're going to have a lot of volatility and you're going to have a lot of chop and a lot of
Mhm.
downward movement. And when you're above it, typically, it's not easy, but at least it's more forgiving and it's something that you can go long and feel comfortable about. But during that mess, when we're underneath the 200-day and the 40-week for so long, you just get chopped up to pieces, like unless you just get lucky or you're just really on fire and in the zone, it really the having a heavy cash balance during anytime you're underneath the 200-day tends to pay off in a big way. Whenever you go over your skis, getting heavy when you're underneath the 200-day, I mean, you're playing with fire. So let's go
Yeah.
back to our
And
current
and
market.
I do just wanna
Yeah.
point out that some of these were very sharp moves up that just didn't last, and
Yeah.
that was what made this so tricky. Because as soon as you started feeling like, "Oh, this is getting away from me," and then you started saying, "Oh, I got to catch up." That's where it really, got troublesome. So you did have the three waves down, but you're talking about being in cash, and I'm looking at the YouTube comments. Thank you so much, everyone, for joining us today. Always appreciate the comments, and a lot of people are asking. So, what would Bill do? Would he just stay in cash? Would he go short? Was it just sitting on his hands? What's kind of, for those that have been taking the Swing Trader product, you've noticed a lot of sitting on our hands. There has been kind of a venture in and then kind of a quick backing out. Shorting, is that part of the product? Is just staying in cash? And what's your take?
Those are all good questions from everyone, and I do appreciate everyone who watches live or recorded, and I think it's super cool that we have such a great community. And no, for this product, we don't have any plans on doing individual shorts. The reason being is you get a big group of people going in shorting a stock, it's got to be very liquid, because the other side of the fence is going to know, they're going to take our product. If you're a market maker or something, and you know playing with shorts is you're playing with fire. So if you want to short it on your own, be very careful, do it liquid names, understand what you're doing. But we could get targeted putting a short out on a swing trading product, and I don't want to do that. And plus, you have this potential for lots of rotations and snapbacks, and really you could be like picking up pennies and nickels and dimes in front of a steamroller. It's like, yeah,
Mhm.
you can make a bunch of little good trades with your shorts and then get your head handed to you. Now, what we might do in the future is doing inverse ETFs. I do those in my own accounts all the time because you have more safety there. You have liquidity, as well as you have that built-in diversification, so you don't have one of those an acquisition. Like if anyone's ever seen a stock that looked very good as a short that then gets bought out, I mean, you just know folks are in a world of pain there, and we just don't want to contribute to that. If you know how to short and you do a good job at it, shorting individual stocks, that's fine. Bill O'Neill kept us, all the PMs kept us at a 10% maximum short. So that was the most we could do in our account. And it was very, very rare. I mean, you got to see exactly what he was doing because you could see his sheet, and I would just talk to him about what he's doing. And I just can't remember him putting on individual shorts. Like, at least
Yeah,
that
I
he
mean,
was.
there was a little bit in the 2000 to 2002 period, but not in a big heavy way. He just so happened to be short at 9/11, and he did not like that. So he very quickly covered. He was like, maybe I can make more money, but I do not want to be taking advantage of vulnerability here, and so he covered. During that time period. Um,
Yeah, well, it's funny you brought that up. I didn't know that. September 11th, that morning, before I left for work, I put a short. I had a futures account at that time in my own account, and I put a short on. Before
just based
knowing
on the action of the market,
based on the action,
not
and
not
I had a
before. I mean, before
well,
what transpired
the first
transpired.
plane had hit, but it wasn't known, and the only news thing, and I was getting ready for work, it was just that it was, just like a commuter jet. Like, no one knew, at least what I was seeing, didn't know it was a terrorist event or whatever, and the market was already weak, and I had been shorting,
Yeah.
because we were in a weak environment, and it was technically, it looked like a good setup, but I put my short in, on with a limit because it was a futures account, and took a shower, went to work, assuming I was short. And then when I found out everything that was going on, I was like, oh my God, let me check my futures account. Like, I didn't want that bad karma of making
Mhm,
money from that. And luckily I didn't get filled. And it was like,
mhm,
thank God, because
mhm.
that guilt would have eaten me alive. So anyways,
But to
yeah,
your
short,
point,
yeah.
Bill, yeah, very,
So
very, very few shorting. And to be honest, most of the traders that we talk to, whether it's Mark Minervini, Dave Ryan, We get to chat with some really great traders, and most of them say like, okay, 1% of my profits,
Yeah.
if that, have come from shorting. It's just not something that, so many of us are just so focused on the long side.
Yeah, I mean, I have done fairly well, I will say, using inverse ETFs
Yeah.
over the decades, and was even doing that back in 2000 in my own account with SPYs and Qs, and that was very profitable. But
And same thing, I think with futures. I think, I'm pretty comfortable doing that with futures, as well. I think
because
it's
you have the diversification, it's
yeah.
not an individual stock, and that's a whole different animal. So, what would
And we
Bill?
did have, more shorting, like, when we first had the product come out. There was a stock, Perigo, that we had on in, 2016. Some news item came out, and it, started jumping, and then it was like, "Oh, that was a rumor,"
Mm,
and, but we had a cover, and by the time it came out that it was a rumor that was unfounded, the damage had been done, and we were already out, so we didn't get to participate on the downside. We were right overall, but it was just not something we could hold. And then we also had problems because I think we went short Boston Beer,
mm.
SAM for a while, but it had the dollar volume, but it only traded like 200,000 shares a day, and
That was a
so
thinly
yeah, it was
traded
very
stock.
gappy looking, and
Yeah.
so, then also we would sometimes put something on, and then people would tell us, "Oh, my broker said that they don't have any of those shares to borrow." And so it
Yeah.
just became one of those things where if we're not gonna be able to do something where, our subscribers can follow it, then what's the point? We wanna be realistic. We want it to be something that everyone can do, and, yeah, to your point, I think it would basically mean a universe of 50 stocks, that we'd
If
be
if
comfortable
if
doing,
that, really,
if
like,
that,
like,
and
probably
yeah,
just 20, 25 or so, that are liquid enough that can't you want to short something that can't be bought out. Like, if you're
right,
recommending that to other
mhm,
people, like, short an Apple or a Microsoft or something that no one can buy Apple,
right,
like, buy out Apple, so you don't have to worry about that aspect of it. But I would just say, hey, look, if you're going to short, really study that, because that is an art, and you can make a lot of money in a very short period of time. But you want to be very careful, and a lot of the rules are a little bit different. Like, when I first started shorting individually, stocks, I would press on it the way I do with, kind of pyramid into the position. So as it was breaking, I would sell more, and then that was problematic because that's actually when you want to be covering. So it's a whole different animal. So just if you want to do it, I would suggest just be very careful and kind of do what Bill had with us, is just keep it, max it
mhm.
out at 10% of your account.
And one of the
Or
issues with this time around is that we came down so sharply, so quick. You kind of get into, again, we don't like to say oversold, but for lack of a better word, you did get kind of that action. In fact, Mike, why don't you share
oh, sure.
some of the, we've talked about the Webby RSI on this show before. You go through it a lot on the stock market day video. So for those of you that don't watch the SMT video on Fridays, Mike is the typical guest, and he goes through his Webby RSI, which is short for a real simple indicator, not relative strength indicator. Real simple indicator, usually looking at how the low is in relation to the 21-day moving average line. But when, and that's what you see in the blue, to let you know when you get a little bit extended. Now, on the flip side, here we are with our high below the 21-day moving average line. We've had more than 10 days with the high below the 21-day moving average line. And now it's starting to get to a level where, in terms of ATRs, which is what's being shown there, in terms of ATRs below the 21-day, it's getting to what's historically an excessive level.
Exactly. And so this is how, when I originally built the Webby RSI, I was only focusing on the low versus the 21-day, the blue one, as you mentioned. And then as I was making modifications and changing it from percent to ATR, I was like, you know what? Let me see this on the flip side to see if there's something I could learn from it. And it was very eye-opening, of that distance that you're when you're above it, it's the low versus the 21-day. When you're underneath it, it's your high versus it. that creates these um, burnt orange histograms. And exactly when we're at 3 or like 3.5 ATRs away from that, it's typically that's an extreme value. There are cases where it gets worse, but those are really rare. And this is typically where at least you have a mean reversion trade, meaning your assumption now is, you know, less on the downside and more that it would snap back up somewhere near your 21 day to make this more normal, where you'd only be like maybe one ATR away from your 21 day, or even you even come up and touch your 21 day. So this is the Nasdaq, and here it is on SPY, and they're both near that 3 level. So that's a bit concerning from wanting to go short, because it's kind of like the heart is already out of that watermelon, and it's more likely that we mean revert now. That doesn't mean, and I'll go ahead and stop sharing unless there is anything else on this that you wanted
No, no,
to.
no. That's
Okay.
mhm.
Because I could go on for 5 hours about that, and we don't want that. So the assumption now is you've gone down so fast, and now with today's action kind of stopping there and not going down much more, and your volume picking up, and I hate talking about volume because I don't use it, but I just know everyone else does, that we should mean revert. Doesn't mean we were going to, but again, what's normal and natural would be to be mean revert, put another way, bounce up.
And even if we mean revert, that does not mean we're out of the woods.
Oh no.
So let's take a look at some examples. Which one do you want me to start with? Do you want me to start all the way back in 2011?
Dealer's choice. Let's go with.
Okay, let's go back to 2011. We're gonna go to a daily chart, and we're gonna go to June 7th. Just as a reminder for folks that might not have been trading at this time, we were dealing with a lot of global recession fears. So what we did here is we started taking a look at is this the right one?
I can't see the chart.
Oh, okay. Well, that's I should share that. Uh,
Sharing is caring.
yep.
Okay.
So yeah, so here we are in oh, I'm sorry, it was 2010 that I was looking at. I had the wrong date.
No
So
worries.
yeah, 620. So basically, Mike just asked me to look at times where the high got below the 200-day moving average line, whereas just within the last 21 days um, we had a close above the 21, the 50, and the 200 on the day where the 21 was above the 50 was above the 200, and so we just kind of pulled out some of these. There were 40. What did I say? 43 instances going back to the 1970s on the Nasdaq. Here's an example where the high is below the 200-day moving average line. So you did come in kind of sharply, and as much as it looked kind of ugly here, it actually got worse. On 8-3, we snapped back. So here's kind of that mean reversion that you're talking about. Snapped back, and then it got ugly again, and it was a lot of back and forth action. Um, for a while, actually. I'm going to jump forward to January 12th, and you can see how ugly it got. This was, by the way, we had gone a long time without having a 20% correction, really since the 2009, 2008 great financial crisis. And we had a 20% correction briefly for, I think, 5 minutes down here. But this was Greece, Germany, austerity talk, possibly defaulting, Greece defaulting, all of that going on in here. But man, what a whipsaw action there.
Yeah, so around the 8th of August there in 11, that's when it was getting to its extreme distance as far as the Webby RSI. So it was maybe about, it's off the scale here, but it looks like about 3.5 or so ATR. So a little bit more than where we are now as far as an extreme. So that's again why and that market was terrible. I mean, I remember like it was yesterday. That was so horrible. And all over the place. And that's what I'm really fearful of, because what happens is when on those big up days, and you have some really beautiful days in there, that upside reversal at the 233165. I mean, that looks very compelling. And then you go forward a bit, and it's looking really good. And then you get a gap down out of the blue, and then you go up, and then you get a gap up, and it's all over the place. This is telling you that there wasn't an equilibrium because the spreads were all over the place and you had these gaps. So we want to be very careful in an environment like that because we'll be tempted to play and we'll try some things because you don't know if it's going to play out like this or like other markets. But one thing that you can use is, are you able to get back above your 21 day and sustain your lows above your 21 day for 3 or more days in a row, still closing up? And you can see there, you get 2 days up above it, and then the third day is down, then you gap below it. And the same thing the next time it goes above it. It closes down the first time, it goes up for a couple days where your low is above it for 2 days, and then you don't get another blue day. So using the 3 days with your low above the 21 day is not foolproof. And obviously, you're not going to be buying near the bottoms by definition because you're trending above your 21 day. But before we would, we're going to put artificial limits on us on SwingTrader and not go in too deep, or we'll be measuring it in how high are the ATRs of the stocks that we're trading. So if we're trading low ATRs, like a 1.5 ATR, meaning it travels 1.5% on a given day or 2% on a given day, we might go in deeper. But if we were trading something that had a 4 or 5% normal move or ATR, we'll have less exposure in the market if we were in the same environment until we start trending above our 21 day. So put in other words, just we need to be cautious until we start trending up because this is a type of market that can just kill you. And we just
Mhm.
don't want folks that follow us to get killed.
Yeah. So I'm going to fast forward a little bit and go to 2016. Now, look, this was just a really weird environment here in August. We were calling it around the office like a mini flash crash. It just felt like the machines took control, and it was just very very weird action. It started recovering, kind of happened again where it just felt like the machines were in control here. But then in in January, we had this situation where we seemed like we were on the recovery side. And then I'm going to just fast forward a little bit more here. And we were, kind of recovering. And then Brexit happened here in June, the Brexit vote, which kind of, I think caught a lot of people by surprise when that vote came out. But then people realized, oh, this isn't happening anytime soon. And there was a big snapback. So anything to kind of glean from this time period?
Yeah. So one thing that I would note is that when you go above and you below your 21 day, or not 21 day, your 200 day, my uh, my assumption is there are a lot of algos out there that are tied to the what the 200 day is, meaning just black boxes out there with tons with billions and billions of dollars that if it's above the 200 day, they go long. Below the 200 day, they lean short or cash. And you can see that historically, like back in the day before there were a lot of algos out there, you didn't have those dramatic moves around the 200 day. But now that algos are a very common thing over the last few decades, as you get around the 200 day, like when we were looking at 2011 or this time frame, you'll see these jumps back and forth. And I do think that's just machines fighting machines. So you've got to be careful and wait for the natural trend to happen. And I think it's worth pointing out that Brexit, where you pointed to, that was an expectation breaker because the day before you close at your highs back above your 21 day, it was a little do a change date to that day because that is, of value. Um, to get your mind, your eyes used to seeing what it would look like before the other action. So you look at this and say, "That's beautiful." Like you finally have a nice little cup with handle that's breaking out above a, prior resistance in there. I would go long and strong that if you gave me that chart again,
Hmm.
because the prior year it was all over the place and things were tightening up, and now go out one day and show that gap down. I mean, that was brutal. So it completely broke your expectation. Then your expectation was, okay, we're going to travel down to the 4209, the old lows. And it was started going down that way. And exactly what you said. Then the market was able to realize, hey, it's not really the issue that everyone thinks it is, you know. And then you were off to the races. And then of course you
Mhm.
had the election and all that um, stuff that year. Or just go out to the end of that year. It's probably worth revisiting and see how much it changed from that
Yeah.
Brexit to up there. And then all of a sudden it started tightening up a couple weeks after that Brexit, and your low was above your 21 day for 3 days, closing up, and then the direction and the whole tone changed. You had more volatility around the election, but of course, we all know how that played out.
Mhm. One more precedent to look at. Let's go ahead and we're going to jump over to 2018. And I should also mention that in a lot of these cases, what we're talking about is some of those, you know, highs in terms of ATRs below the 21 day got to about 3.5, 3.9. So to some of those extreme levels. So we're not there yet at those extremes that we're seeing in some of these cases, but at three, you start kind of looking for it, the bounce back. Doesn't mean you're out of the woods. There could still be a lot of slop and chop, but something to be aware of. Now, in 2018, this was kind of a particularly, I don't know, a little bit challenging as well because you had a lot of Fed action, swaying things. Jerome Powell was a little bit new to the job and trying to
He messed
trying
things
to
up
manage
too.
that.
He like
um,
he was out at Jackson Hole and just messed things up. I think it was January 4th from memory where he went back out with I think
yeah.
Yellen and Bernanke and sat down and had a little speech. And from memory, he had a little sheet of paper that he read straight off of, and then the market was off to the races because it was like, okay, he brought his backup in with Bernanke and Janet, and then they had figured things out, and then we just snapped back
Mhm.
and ripped up.
Yeah.
So the point there is that the news can turn from negative to positive. So like the whole Ukraine situation, if that resolves itself to a point where that the market likes, then we run up. Same thing with the tariffs or anything else that the market is concerned with right now. They can resolve themselves, or just like what happened with the Brexit. It was like, oh, this is terrible. Oh no, it's not really terrible once the market can digest it. So that can happen with all the negative news items that we have right now. So that's why we're keeping such an open mind.
Mhm. Yeah. Okay, real quickly, I want to just kind of revisit our slides that we typically go over, just as part of a uh, refresher on where we're at. Um, was this our positions last week or this week? Oh, it's the same. All cash, all cash. Last week on Tuesday and this week on Tuesday. And look, this is a big reason why we as we mentioned on February 21st, we did, here's our equity curve. We did go below our, and by the way, it's going to be a 50-day time frame, but we did some changes. And so right now it's just year to date. On Friday, we'll have 50 days, 50 trading days. So we'll be reverting back to the 50-day rolling period. But we have the cross below the 10-day moving average line that kind of put us on the defense. And you can see what happened with the S&P 500. So the fact that we really lightened up considerably and haven't gone heavy since is what's giving us a lot of outperformance right now. We're just basically going flat while the S&P 500 has been going down. And as you can see, this is our relative strength line versus the S&P 500. That's been shooting up pretty dramatically. I actually had to change the scale on this side because the relative strength line was coming up so high and the S&P 500 was coming down so low. So I didn't want them, crossing streams like in Ghostbusters. But yeah, that's where we're at right now. And anything to add on that, Mike?
Who are you going to call?
Yeah, right.
So the one thing I would expect over the next week is that, because even if we get in the market, we're going to be on the light side. That RS line, ours is going to dip down over the next week because you'll get the bounce. But if what I'm thinking is going to happen happens, where we're likely to get that mean reversion bounce up. And if we're on the light side of things, because from a risk reward standpoint, it doesn't make sense to be heavy right now. Even thinking that you're going to have a bounce back, because it doesn't have to bounce back today. It could bounce back starting next week. That we're going to give up ground. And so you
Yeah.
have to be comfortable with that and just go, okay, at some point, you have to start getting in so you don't lose up too much ground. And this is the trickiest part when you're, and so we're really going to pay attention. We don't want our distance from our 10-day of our equity curve to get too wide, because like right now we're not far from it, and a little move up in the right direction will get us above it. And again, we've talked about this before. When you're above your short-term moving average on your equity curve, so a 10, if that's what you use, that's what we use. You could use a 5, you could
And
use
you
a
know, I
15.
should have mentioned, I should have just described this real quick. The
Sure.
equity curve is the purple line. The 10-day moving average line is the yellowish orange, and then the 21-day. It's just a simple, not an exponential. That's the blue line here, and then of course the black is S&P 500. So
Yeah.
for
And
those that
then on
aren't
the bottom,
familiar
can
with,
you explain the bottom in case
and then
we
the
don't
bottom
know?
here is our percent invested. We've got, we're the 100%. So we were on margin going in because look, we had a lot of, we had chips to use, right? Now maybe we were getting extended. Maybe we could have gotten off margin a little bit quicker. We're going to do some post analysis on that. But yeah, we were doing well, and our relative strength was also doing well at that time. It wasn't until, again, that hard hit on the 21st, and actually a little bit before that, a couple days before that, we saw leaders cracking, starting with Axon. Palantir came down, but again, we got out quick enough then, and really didn't get back in. So for some people, you might be, if you're on the product and you're like, well, gosh, did you guys fall asleep? Why aren't you doing anything? That's a feature, not a bug. This is what we do. We try and keep you out of trouble when things aren't good. We'll kind of test the waters, quickly back away. We tested it with some China exposure. We tested it with some international exposure, but we quickly backed away. And so that's kind of where we're at.
Exactly. And so what I would suggest people do at home is take, whether you're swing trading, position trading, or doing a combination of both, is get your equity curve, plot it out, and put moving averages on there, and find which moving average works best for your style of trading. And try to, when you're above your moving average, that's when you press the gas, because you are by definition doing well versus yourself. When you're underneath it, that's when you need to contract and get smaller and be more on the careful side, so you don't end up in a tailspin. So that's what we're doing here, and that's a lot of, it's the hardest part of trading, is knowing, when to be light. And if you're racehorses like we are, well, I don't want to put that term on you, but I'm a racehorse, and that's the way Bill would refer to us. You want
I'm
to
an old
go.
mare.
You're what?
I'm an
You're
old mare.
no man. Um, so that's, hey, that's a safe way to go. But if you're an old racehorse, and we did have an old racehorse, a businessman growing up, he was a family pet, and he used to race at Santa Anita. But anyways, the when you're an old racehorse, you want to go. You want to go fast, and so sitting on your hands is not a comfort. Like you said, but it is a feature, not a bug. And
Mhm.
so
Yeah.
we'll be racing again as soon as we have the right market.
Well, and I will say that that's one of the things. So, not to make a plea to not cancel, but if you cancel the subscription, the problem is things can turn so quickly, and then you're not going to get those alerts when we start ramping up. Certainly you can wait until the Tuesday to kind of see where we're at and get a sense, but uh, you're not going to get that real time like our subscribers do. Mike, let's go ahead and go over a few stocks. One of
Sure.
the things that was kind of interesting about this week is that we had a number of stocks that were looking good. And this seems to be the case a lot of times in bear markets. They're looking good, and then they just don't. So CBOE is an example of that. I mean, I was covering CME on the stock market today video yesterday. This one held up a little bit better, but I mean, CBOE, that looked just fine yesterday. and not so much today.
Yeah, and I think you said it exactly right. When you're in bear markets or intermediate corrections, your things that are holding up, what happens is the PMs or anyone out there who are in them, and you're getting killed in all these other things, and you see something that's sticking straight up in the air, you're like, "Whoa, I better take it while I can." They sell it, and not everyone shorts the way we short. Like, we short after the fact, like a head and shoulders top. Some people like shorting, breakouts, and shorting a breakout failure in a bad market is not a bad, I don't do that, but it's not really a bad strategy because they tend to work, you know because when it breaks out, most of them will come back in like this one did. And so that's why we're avoiding those. But one that we did try was buying something on weakness, and that doesn't work. Nothing really works in these. Let's go to bros. We weren't going to talk about it, but I think it just came to mind. And we were buying this as it was coming in near the 50 day, and we thought it was going to get support, and it didn't get support. And that's why you need to exit it as soon as it's breaking your expectations. So we didn't take a bad hit on that, but we could have if we would have said, hey, Mike thinks Dutch Brothers is the next in and out, and let's give it more room, and let's give it a, and rationalize holding a losing position. That's not what we're here for. So it wasn't working, so we backed away. So really the ideal thing is buying the strength after the weakness. But with this one, because there was a higher ATR, we knew that we couldn't do that. So it was either we gave it a shot there or we let it go. And so I would do the same trade over again. And you give it a, well, I'm not sure about that. You give it yeah, I'll have to think through that. You give it a shot, and you've got to back away when it's not working.
Yeah, it's okay to give it a shot, but you have to make sure that you don't overdo it.
Yeah.
And that's again something that I think I learned very early on. I just overdid it. I over traded because I missed the '90s, and I was still trying to party like it was 1999, and it just wasn't anymore. So yeah, you have to go in incrementally. You have to kind of make sure you're being um, prudent with your buys. I just wanted to go through a couple others
Sure.
that were on that side of looking okay until it wasn't. McDonald's was one. We were noting just internally some of the strength that we were seeing in a lot of biotechs and stuff. And Excel, Excelix, EXEL, that looked fine. Yesterday looked like it was kind of breaking out of this little short, area here, and came down pretty nasty. ECL, Ecolab, you know, I mean, this is as boring as you can get. It's in the soap and cleaning preparation. This is your definition of your staples and your defensive where people hide. And here we are coming down 2.5% for something that normally trades very, very mildly. But now on the flip side, oh, go ahead.
I was just gonna say, and look at that RS line. It was
Yeah,
smoking up there, and we were,
smoking.
yeah, we were sitting on our hands because we really wanted to put this on the list as it was, um, a few times, because it was holding up so much better, and really because of that RS line. But again, in these environments, if you've been in them enough, you just know that really cash is king, because it's very rare for something to, in this environment, break out and continue higher, because you have those people who just want to sell whatever's up just to lock it in. Until that changes and we start seeing a bunch of these things breaking out and sticking, we're going to be heavy cash.
hmm Now, one of the other areas that's been looking interesting, I mean, AEM, Agnico Eagle Mines, this is actually on leaderboard and has been for a while. We were playing some gold plays, and then we just kind of again went to cash. But this just crossed 100. You had AU that was looking, not as strong. AEM certainly seems like the stronger of most of the miners, but that one was looking pretty good. And then you also have China. Alibaba, this isn't a bad look. A lot of strength here, relative strength soaring, but there's a big difference between the ATR on AEM and the ATR on BABA.
Exactly. So if you're an aggressive trader, this is what you're when you're looking. I was trading this until Friday in my own account, and just exited it because of what was going on here domestically. Thinking that what, we might have a sell off, regardless how good something was looking, and that one sold off quite a bit yesterday. So I'm glad I sold on Friday. So, but we're watching this and other ones in China, because there is that thing where you can have other markets, or things like the AEM looked great, probably best looking chart out there right now, or certainly one of them. And so you can trade these types of things because they're kind of they're not as correlated to what the S&P and the
Yeah.
Nasdaq are doing. They still, everything's correlated, but this is about as uncorrelated as you can find. Both of those, and KWeb is one way that we might play the BABA. We were playing it through the CHI, playing the China thing, because it had a lower ATR. So we might do that instead of the KWeb. But KWeb is the stronger looking one, um, frankly, and it has a big BABA position. So there's your stocks in Europe. Let's just pull up EFA, which is kind of a global.
Yeah.
It's got
And
Europe.
one of the things I was going to say about
Yeah.
maybe the attraction on the international side is you've got to remember that, looking at a monthly chart, you know, international has kind of been, I mean, look at this relative strength line versus the S&P 500. It's been out of favor. So it's easy to see the attraction if you're kind of like, well, look, this has been out of favor for so long. If we're going to be fair, it's got to be its turn. Now, like, a lot of people have been saying that on the international side for a long time, and the US has just dominated. But same thing for China. MCHI, a really nasty sell-off that we've had. Whether you look at MCHI or KWeb, just not performing nearly as well. The US has been the place to be. So you can understand why some people would say, okay, well, if the US isn't the place to be, here's where I'm going to venture.
Yeah, the tricky thing about that, all well said, that if we get our market turning, the money
Yes.
that has been moving over there, just like what we saw with the ECL and the McDonald's and stuff, they could say, "Oh no, it's the old playbook. The U.S. is going to dominate, and the rest of the world is going to lag," because that's what we've been seeing forever.
Mm,
And that could happen. So that's what makes it super tricky. But most likely, if we start getting invested, probably looking for some international ETFs that trade with a relatively low ATR, that give us a good stop on there, and just recognizing that ADRs, which are foreign stocks traded here, or international
That
ETFs.
stands for American Depository Receipts. So not to be confused with ATR's average true range. So,
Thank you. Or some people call them average daily range, for like if you don't account for the gap. So yeah,
right.
you can have a anyways, so what can happen is these are all gappy, just because their market is open at different times than ours are. So you bring in this extra risk. So what to expect from swing trader? We'll wait and see when it makes sense to start getting exposure. If we start getting exposure and we're making progress, we will do what we always do. We'll increase either the risky stuff that we're putting on there, so higher ATR, or just the level of exposure that we have. But if they're not working, we'll just back away. But something in gold, something on the international side, something, whether it's Europe or China. We're very open minded to that. Yeah, trade web.
Well, yeah, one more I
That
just
looks
wanted to
good.
cover. And again, the risk here is that a lot of things have been looking good and then they don't. I just wrote a column on this not too long ago, that you can find on investors.com under the research page and swing trading. Because we tried this, we were getting in on this, and then we quickly took our profit because of just this downside reversal, and we saved ourselves a lot of drama because we did. But look, it's got a good RS. like we saw with a lot of those other ones, but we're again kind of keeping it close to the vest for now. Yep. So
Good.
I guess that's it, right?
Yeah.
Thank you so
Well,
much for your
good.
time, Mike.
Otherwise, I'm gonna keep talking, man, and you
Right,
need to
I know, yeah,
sleep.
we will. Yeah, my poor son is homesick today, and so he's like, "When can I use the internet again? Just, tell me." So
Please tell him that Mike says he hopes he feels better sincerely.
I will.
It's no fun.
Well, thank you again, Mike. And again, for those of you that are subscribers to Swing Trader, we'll be keeping you informed with those, alerts, as we come by. And then also at the end of the day, we do our kind of a quick little wrap up so you can kind of see where we're at in terms of our invested percentage. Right now, it's easy. We're at 0%. But those alerts will keep you in sync with what we're thinking and where we're looking. So thanks so much for watching this week. I'm going to stop my share because I'm sure that's what Dominic is waiting for me to do. Uh, so he didn't have to come on and yell at me, but we will see you all next week. And thanks a lot for watching. Bye bye now.